And yeah, I'll bridge the time as they walk up just by echoing some of what Chris said. We found, and I guess I didn't necessarily formally introduce myself, I'm Brandon Bruce, I'm co-founder of Cirrus Insight. We're a software company here in Knoxville. When we went to go raise our first money in, we thought that we had a great deal from a strategic investor, a software company, that had agreed verbally to put in money, so you see where the story's going. The day after they had made that agreement, they got acquired by Dell. Which shut down all of their M&A activity, and so that was the end of that deal. Thankfully, though, that was our first opportunity to actually write down a plan, and we were able to leverage that to raise money from angel investors. But to echo what Chris said, definitely harder to get the check than to get the yes. Well, thank you all for joining us for the growth panel. So this is, in large part, either companies that have bootstrapped their way to growth or received money early on from some of the early stage investors or friends and family and gotten to a point that you all get interested in them. So to start out, let's do our quick introductions, 5 W's. What brings you here? Who are you? What do you do? How much money do you typically invest in a growth round?
So we counted in the back, and it was 6 W's, by the way.
There's 6 W's?
Yeah.
Okay.
But I don't know what they were. Anyway, I'm John Morris. I'm a co-manager with Geoff Robson of the Lighthouse Fund. Here in Knoxville, we're an angel fund, which means that angels have put money into our fund, and we are managing that fund through a process of investment for companies that have met 2 criteria. One is they have sold something to someone, and the second is that they're bringing leveraged investment or bringing someone else with them, and we're not the only one in town. So that's what we do as a Lighthouse Fund. I'll let Geoff give you the particulars on how big and what's over later on. But that's what we are. Here in Knoxville, we have invested in companies from other states. So we're just looking for good deals, but we have a geographic ring around Knoxville that we're sort of concentrating on.
Okay, super. And do you want to say for 2017, deals that you did and your outlook for 2018, or you can put that on Geoff?
I'm going to put that on Geoff.
Okay, good.
Yeah.
Geoff, you want to take it from here, and then we'll return to Eric. That way,
we can do it however you want to, Brandon.
All right, let's do it.
Before I get started, though, I want to tell you I really like your socks.
Thank you. Went to a basketball game last week, and we won.
Yeah, absolutely. We've been doing a lot of that lately, haven't we? Good stuff. Did you hear about Bruce Pearl and his players the other night coming off the court? The fans started throwing money at him. His first response was, we're all about compliance at Auburn, so we're going to turn this all into the compliance department, and it's about $6. So that's good news. Anyhow, I'll add a little bit to what John said, and I appreciate the opportunity to be here, and glad to see a great turnout tonight as well. So we have done 7 deals to date. As John said, most of those are in the East Tennessee region. We have a couple out of state, one in North Carolina and one in Atlanta. We're not geographically limited. We're more focused around the profile of certain industries and business models that we focus on. And if you look at that from our investors' perspective, that's really where they've made money. We tend to focus on that because we like to add value beyond the money. I think that's one thing that's important. Frankly, in 2017, we were a little short of our targets. We did 1 new investment and about 5 follow-on investments. With 7 companies in the portfolio, we're still looking to add 3 to 5 new companies. And we have dry powder sufficient for that, as well as follow-on investments. So I think that's a pretty good overview.
Yeah, what was for the new investments, what's average check size look like, and what do the follow-ons look like?
So 50 to 250 is kind of the normal range of what we'll invest. We typically don't go over 250. As John mentioned, we syndicate all of our investments. So we've done rounds anywhere from $600K on the low end up to $3.2 million on the high end, as far as total investment in the round is concerned.
And are those all equity? Are you using some debt in those deals? Are they hybrid?
We have done a little bit of both, yeah, actually, which is pretty normal for the stage of investing we're at. Typically, if there's a price round, obviously that would be equity, but a lot of the companies, as Chris mentioned, as they go into the bridge process, going to the next round, that's typically a convertible note of some form.
Awesome, thanks. Eric, Angel
Hey.
Capital Group.
First of all, I feel like I'm in a Lighthouse sandwich here. I don't know if that's good or bad. Anyway, no, one of the things. Yeah, I'll go with that. Anyway, Angel Capital Group. We are a strange beast. We're on business model number 3 for angel groups. We're now a syndicate of angel groups and funds. So we're headquartered here in Knoxville. We've done several deals. We got one in the back of the room here that we did. It's one of my favorite ones. But we did do. I think we invested in Arcus last year, and again this year. So we've actually it was this year. I think we did a quick round with them just recently. So we've been in several deals in Knoxville, and we're happy to be here. Patrick exited. He was one of my favorites. So 5 works. Let's see. What do? We invest in primarily science and tech-based businesses. Because of the way our fund works, all of our deal flow now comes through our individual funds or groups. And of course, Leo Knight here is my Angel Capital Group leader for Knoxville. So, that's how we used to push the deal flow from the top. Now we pull it from the bottom. So the good news is by the time you get to the top, you've already got at least one sizable investment behind you to lead the deal inside our syndicate. And therefore, so our minimum is about 50. I think our largest we've done in a first round is about 500, but typically 50 to 250, as Geoff said, is probably normal for a first round for us. We are prepared now. One of the things that's great about the syndicate model is it sort of mimics a lot of what Grady said about an evergreen fund, because we keep adding more and more funds and people and cities to this network, so we just keep aggregating more and more capital, and folks do second funds, third funds, things like that. So we're now doing second, third, and sometimes even fourth rounds with these companies to get them to the point they can either grow organically or qualify for a big VC round, or we move them over to private equity or something. So we've been very successful at doing that lately. We've got one company of ours that we put $1.5 million in. It's our largest individual deal, and they got another $12 million committed on the heels of that investment to take them all the way through commercialization. So we've been very good at that. What else did you want to know?
2017. How many deals did you do? How many would you like to do in 2018?
We did, I think, 5 new. We tend to do about 10 deals a year. We did 5 last year that were new, and 5 that were second or third rounds. So it was a kind of an odd year. That's the first year we've ever had an even match. Usually it's 2 or 3 in the follow-on. So we expect to get back onto the 8 to 10 deals a year kind of path here very shortly, probably this month.
Super. So back to you, John. When you guys are investing at Lighthouse, do you have a target percentage that you're trying to get? Obviously, the check size may vary, 50 to 250, sometimes more, 3.2 million. But are you always looking for a range in the target percentage? And then the follow-on question to that is time horizon. If you have your druthers, you'd like to see a return on money in how many years?
So we don't have a target percentage. And the reason for that is there's a lot of variability in the types of deals that we invest in. Some of them, as Geoff mentioned, are larger rounds. Some of them are smaller rounds. Some of them have had equity before. Some plan on reserving equity for later. So that percentage is really almost doesn't even come into account because there's just so much variability in that. So we don't have a target percentage. It's really more about the value that we think the company can bring through the growth of the capital that we invest. What was your second question?
Time horizon.
Yeah, time. So 5 to 7 years is what we're looking at to have a company exit. Now, if anybody in here can pick 5 to 7 years when they come to us for an investment, great. But, some are longer. There may be some that are shorter. Of the ones that Geoff had mentioned are in the portfolio now, we've got, I'd say we have 2 that have some potential of exit, just on the near-term horizon. We've got others that are continuing to grow. So it's a little bit of, a mixed bag. Yeah.
Eric, what about for you at Angel Capital?
Well, I forgot to mention earlier that we merged with another network back in 2014, essentially. And between the 2 networks, we've actually invested over $48 million over 12 years. So we've got a long history and a deep, a big portfolio. We're still managing a number of those actively, and we'll continue to do so. In terms of time horizons, obviously we love 3. That'd be awesome. We will sort of accept 5, and we'll sort of take 7 grudgingly. But yeah, we want to see the money back in 5 to 7 years is probably a reasonable time frame. That's kind of what we expect.
And Geoff, favorite exit so far, or favorite investment in the portfolio that you're looking forward to exiting in the future?
Yeah, well, we haven't had an actual full equity exit yet. We're only 3.5 years into the fund, so that would be a little early. We have had a company return dividends, so positive returns back to investors so far, which is a good thing for us.
Was that expected? Was that a milestone that you all wanted them to hit?
Yeah, it was built in up front on that deal. It's just kind of the nature of the deal, so to speak. Probably our favorite company, obviously, but besides our 2 Knoxville investments, Arcus and Vendor Registry, would be Canopy out of Raleigh, North Carolina. It certainly would be one of our favorite ones so far. So.
And then building on what the folks said in the early stage panel, when you invest, is it pretty clear up front, these are the milestones we're hoping to get you to, whether it's another financing round, or this is going to get you to break even or profitability, or this is going to get us a dividend?
Yeah, and the dividend was unusual. I'll say that's not a normal part of it, but again, a part of that deal was just structured that way. The milestones, from my perspective, Brandon, kind of fall out of the investment process. As you get the initial pitch, get to know those founders of that company and kind of see their plan developing over time, it kind of becomes inherent to the process that there's some milestones they need to hit. Obviously, from a cash perspective, being one big driver, but secondly, just what strategically is going to add the most value between this round and the next 2 to 3 that we expect to see.
Makes sense. Eric, on your side, do the angels come in and say when you guys are doing a deal? Because creating a syndicate is kind of interesting. Do each of the individual angels choose to invest in that particular deal, or is it expected that if they're participating, their money's going in because the group voted?
Both, actually. The funds, the individual microventure funds, they will vote internally and they will commit funds on that basis, but every individual member may also add money on. So we've got a hybrid structure that allows anyone to create sort of their own personal portfolio out of this, and that's one of the things we really enjoy that a lot. It works very well for us. Where else are you going with that question besides that?
In terms of setting milestones, is the expectation that this is going to lead to another round or to an exit or an acquisition type activity or some other revenue or sales-based milestone, or all of the above?
Yeah, a little bit of all. We expect that our companies are going to raise at least 1 to 2 more rounds after us. We just have to expect that. A growth company is going to do that, sort of in the nature of the beast. So clearly we do set milestones with these companies. We're very involved in these companies. We typically take a board seat. We require quarterly reporting and pretty invasive at that. So we want to get detailed financials. We're looking for problems before they become catastrophes. We're looking for opportunities for these companies that we can leverage around the network if they need something. But yeah, we typically set, and as Geoff said, it comes out of the whole process of diligence, the milestones that we expect them to hit before we're going to be, and we tell them this before we're going to come back in with more money. You need to be here. And typically that's a valuation measurement. That's it's some kind of operational revenue, whether it's number of users or something, but there are clear metrics that we measure every quarter before we'll consider coming back in.
And John, Eric mentioned LPs. Is part of the value of both Angel Capital Group and Lighthouse just access to the network of LPs, and do they frequently invest in addition on their own or even instead of? Maybe the fund passes, but the LPs get involved in a deal?
We've had both cases, yeah, where we have our sidecar investments from existing members and also members who invested in a deal that we passed on. We've had both. We're a member managed LLC as a form of the Lighthouse Fund. So our members vote on every deal, but we have a gated process that we go through to make a decision. Geoff and I will be the first gate, along with a partner of ours, Randy Smith. And then we have a core group, a board, if you will, that actually hears the deal, reviews the deal, does diligence and questions on the deal, and then we actually go to our members for a vote on the deal. So we've got a very defined process that we go through in order to determine that. And I'll add one other thing. We typically, well, not typically, we as a process will reserve and ask for in that vote enough follow-on for the follow-on investment in that company. So when that company comes back to us, we don't have to go back through that process again. It's already approved by membership.
Gotcha. So have the members put that money in at the beginning, or you're asking them on each investment, hey, we want to put this much in reserve, and they're making new commitments?
No.
each time?
They've already made commitments in the fund. Okay. They're just voting on the money that exists right now to invest in that company and reserve for future follow-on investments.
Gotcha. And then, since all of you have members that are angels, and a lot of this has been entrepreneurial focused, but as we learned before from Chris, who talked about raising money, a lot of the early rounds are from entrepreneurs and business leaders that have put money in themselves as individuals, or they're members of funds like yours. So for the investors or prospective investors in the house, how does somebody join Lighthouse Fund? How does somebody join Angel Capital Group? You guys want to talk to Geoff? You want to talk about Lighthouse first?
Yeah, we are not really actively seeking new members right now, Brandon. We're pretty well committed where we are right now. So from that perspective, we're always interested in meeting with those people and learning about them and sharing our story, so to speak. There has been some discussion among our board about a second fund sometime in the near future. So obviously, we're building those relationships now in case we decide to go down that path.
We'll take you all.
And how does somebody join? This is on the website. Is there a minimum commit?
Honestly, yes. The person, Leo, again, I keep looking at Leo. He's our chapter leader here, and he's kind of the guy that coordinates that. Absolutely. Eric.Dobson@angelcapitalgroup.net. Please send me an email. Be happy to meet. You're welcome to come to our meetings. We typically have a few guests at a meeting. Sometimes we ask them to sign NDAs, so that little NDAs, so they can see the companies. But we typically have guests, and we're happy to have them. It's a very open, transparent process for us.
And can folks essentially make an ad hoc decision, like, hey, this looks like a good company, I'd like to get in, or is there an upfront, like, I'm going to participate this year, and so I'll put in 25 or whatever the threshold is?
If you're in one of our funds, there's a minimum amount, and it's committed basically for over a 3-year period. For our group, typically we ask for a minimum of $10,000 investment every year. So it's a pretty low bar to trip over. Yeah.
One other thing I'd like to add, and I've had a little bit of reminiscence as I've been sitting up here. I built a company from 1997 to 2004 here in Knoxville, and we raised primarily angel capital to fund our business from a capital infrastructure standpoint. We raised 2/3 of the money from Huntsville, Alabama, because Angel Capital Group didn't exist, Lighthouse Fund didn't exist, Three Roots Capital was barely getting off the ground. The capital resources that exist in Knoxville today, as opposed to 15 years ago, it's just night and day. We all know we can do a better job, and we're striving to do that on a regular basis. But just to look back and to see where we are today versus where we were 15 to 20 years ago is just amazing.
Knoxville's trending.
Yeah, absolutely. I came in 2007. I moved back here because some investors wanted to start a company, so I came back for that reason and began raising capital in this town. And it was literally, I was at the inaugural meeting of the Angel Capital Group in Knoxville, got an investment, and then later when that company exited, I joined Angel Capital Group. So that's how I got here, and that's why I'm doing what I'm doing. So it has a lot more history than most people think here.
Awesome. I'll pause for a second. Does anybody I've got more questions, but does anyone out there have a question, a hot potato they want to throw at the panel? Any takers? This is your chance, right? Anything. They'll answer anything. Say again?
I said, is there anyone that invests in things that aren't tech?
That's a great question. Yeah, what industries are you looking for? Is it any good company? Is it just technology, IT, or biotech, or 3D printing, or what are you guys focused on as we look into 2018? What's a great investment look like to you in Knoxville?
Let me take a stab at it first, and I'll turn it over to you guys. If you go to our website, lhfknox.com, we're very transparent there as far as our process and the types of industries we like to invest in. So I'm going to reiterate again, what we invest in is typically where our people have made money. right? So we have a lot of entrepreneurs in the fund who've been very successful, and they're interested in investing in areas that have made money in the past. So whether it's healthcare services, healthcare IT, software, software as a service companies, things along those lines, that's where all of our folks have made money. And frankly, that's kind of a best practice we're going to stick to, because we can add the most value that way, but also help those people, again, achieve a higher level of success.
I'll add to that and say that the key to investment is a high growth plan. Not that it's tech, not that it's some specific vertical market, but it's whether you have a high growth plan. And I'll point out that Pilot was a gas station when they started. They weren't the national chain that they are today. Regal was probably a cinema before they started. I don't know that whole story, but it's the plan that you have. That's what people invest in, is the management and the plan, not necessarily the tech. I've heard it said many times, and I've seen it as we've done things. Investors like to see an A team, or they'd rather see an A team and a B idea than a B team and an A idea. So that's what people invest in.
And just to give an example for that, I mentioned Canopy earlier. Canopy is not a high-tech company at all. These guys are in home residential maintenance, basically maintenance outside the home. Now, there's a lot of tech inside that company that gives them a competitive advantage at the end of the day that's helping them to grow very quickly, but they're not a high-tech company by any sense of that description.
Well, building on what Geoff said, we query our members every year. So coming into 18, we sent out an email saying, okay, everybody, here's what we did in 17. Tell me what you like, tell me what you didn't like, tell me how you want us to improve this process, and here are the things that we think we're good at. Tell us what you think we're good at, and then tell us what you'd like us to get better at. And by and large, those are all science and tech. So medical devices, advanced materials, specialty chemicals, we're kind of an odd bird in that respect. We really like the harder side of tech and science. But we do look at SaaS platforms. I mean, Fiveworks was a SaaS platform. We look at some IoT deals. We've done a fintech deal. So we've done some other stuff, and we're open to that. But again, as John said, it comes down to the management and the plan and the investor's willingness. Because essentially, I run a beauty contest. That's it. It's as simple as that. And the prettiest one gets the money. So I'm a bit at the direction of my investors on what we bring to the table. Although we frequently float deals out there. Hey, does anybody want to look at this? And just to make sure we're not missing some important segments that our investors want.
Awesome. I think we have time for one more quick question. Yes, please.
There was a very interesting statement that you made that people invest in a B plan with an A team. Can you kind of expand on that? What does an A team look like? What's the criteria that you look at and go, oh, this is a really good manager?
So, one that executes. It's as simple as that. And if they can, one that executes, a team that executes. You're going to see in the startup space, you'll see anywhere from somebody who has left their good job to start a new company, and they don't have any history in management of a startup. And you're going to see people who have been around the block and done it over and over again. But it's the execution of their plan that makes them an A team. And that's what you're really looking for. So, if somebody comes up to us and they say, I want you to invest in our company, they need to show this selling something to somebody criteria that I mentioned ago. That's what they call traction. So we want to see that they've sold something to somebody and that they have enough minimally viable product to make something out of that, and that they're doing it already.
I'll go as far as to say we're looking for A teams with A plans, but that's a different story. In general, that's what we're looking for. Essentially, we're looking for a new investment. We're looking for three functions. We want to make sure there's somebody that understands the finances, somebody understands the tech, and somebody understands marketing and sales. Because very simply, once I understand your product, and that should take 2-3 sentences, All I want to hear about is how you're going to market, how you're going to sell, how you're going to return capital, because that's what investors are looking for. So having that kind of information, understanding the process, and demonstrating, as John said, a history of execution. And it doesn't necessarily have to be entrepreneurial, but it has to be something that demonstrates you can adapt, overcome, a lot of the key words about just being agile and flexible and never saying die. Of course, we're looking for that. We're looking for passion. There's a lot of intangible things that go into, quote unquote, an A team. And in fact, actually, a lot of our applications for funding, we actually ask for Myers-Briggs for the whole team. And part of that is we want to see how the team's going to interact. Because the one thing we can't quantify very well yet is the entrepreneur. We can do great. I mean, there's lots of data on startups and all sorts of things, but there's very little quantification of the entrepreneur. And as they say in the industry, we bet on the jockey, but we buy the horse. Okay, so.
Just to add one quick thing to that.
Do it, bring us home.
A lot of this is about relationship building. So if you have questions like that, reach out to somebody. Okay, we're all very transparent, open, easy to get to. Frankly, a lot of the investors you're going to see on these panels, we all have existing relationships. I mean, we've done deals with 90% of the people that are on these panels ourselves over time. So if we don't necessarily have the right answer for you, we can tap that set of resources for you very quickly and get you to the right spot to help you solve those problems and get through it so you can get to a decision more quickly. So don't be afraid to do that.
Yeah, I'll just briefly echo Geoff's point, which is to say, I think that's one of our advantages in Knoxville as a relatively mid-market, smaller city, is that once you know any of the people that have come up, then you can get to know everybody pretty fast. Everybody in the investment community knows each other. My experience has been everybody's really willing to help and make introductions. So that's a great advantage for us here, I think. Thank you all. Appreciate it.
Thank you.
Thank you.